Most investors don't fail at the beginning. They fail after they think they'd figured it out. Years 3 to 7 are where confidence peaks, discipline slips, and small mistakes start compounding in the wrong direction. This is the phase almost no one warns you about, and where roughly 90% of investors quietly fall off track. In this video, we're breaking down why investors fail in this exact window, the psychological traps that show up, and what separates the few who push through from those who don't. Before we get started, if you want to survive the hardest phase of investing, not just the first one, hit subscribe. This is where investing blind spots get exposed. The overconfidence trap. After 3 years of investing, something dangerous happens. You've survived the initial learning curve, made some winning trades, and built a decent portfolio. Your confidence is sky high. This is exactly when most investors start taking unnecessary risks. They think they've figured out the market, but what they've really experienced is just one market cycle. They start putting more money into speculative investments, abandoning the basic principles that got them this far. The market has a way of humbling those who think they've mastered it. When the next downturn hits, these overconfident investors are caught completely off guard, often losing years of gains in just months. Lifestyle inflation kills growth. Here's the part most people never talk about. Somewhere between years 3 and 7 of your career, your income usually starts to rise. You get a promotion, a raise, or maybe you switch jobs for better pay. On paper, everything looks like progress. But this is also the most dangerous phase for building wealth. As income goes up, spending quietly follows. The money you once invested every month slowly gets redirected into a bigger apartment, a newer car, more expensive habits, and treating yourself because you worked hard for it, and it feels justified. You tell yourself you deserve the upgrade, and maybe you do, but the timing is the problem. This period is exactly when compound interest should be doing its heavy lifting. These early to mid years are incredibly powerful. Every dollar invested now has decades to grow. When you skip investing during this window, you're not just missing out on that dollar, you're losing what that dollar could have turned into over time. The cost isn't linear, it's exponential. Chasing quick returns. By year 3 or 4, the slow and steady approach starts to feel painfully boring. You're doing everything right, but the results don't feel exciting. Then you look around and see people bragging about crypto wins, hot stock tips, or real estate deals that supposedly doubled overnight. Suddenly, your index funds earning 8 to 10% a year seem small, even disappointing. This is the danger zone for long-term investors. It's the point where many people abandon their original plan and start chasing fast money. They jump from one opportunity to the next, hoping to catch the next big wave before it takes off. The strategy shifts from patience to excitement, from discipline to speculation. The problem is timing. By the time most people hear about these amazing opportunities, the big gains have already happened. Early insiders are quietly selling, while latecomers are buying at inflated prices. When the hype fades, panic sets in, and people sell at a loss. It's the exact opposite of how wealth is actually built. The investors who succeed understand something counterintuitive. Boring is profitable. Steady, consistent returns may not make great dinner table stories, but they compound reliably over time. An average return earned consistently over 7 years will almost always outperform flashy gains that are followed by massive losses. Lack of emergency planning. Most new investors focus entirely on building their investment portfolio. They forget about building an emergency fund. Then, life happens. A medical emergency, job loss, car breakdown, or family crisis hits between years 3 and 7. Without proper emergency savings, these investors are forced to sell their investments at the worst possible time, often during a market downturn. They lock in losses and destroy years of progress. The successful investors maintain 3 to 6 months of expenses in easily accessible savings. This buffer lets them ride out personal emergencies and market volatility without touching their investment portfolio. Emotional decision-making. The period between years 3 and 7 usually includes at least one major market correction. This is where emotions destroy portfolios. When the market drops 20 or 30%, fear takes over. Investors see their portfolio value plummeting and panic. They sell everything, trying to prevent further losses. Then when the market recovers, they're too scared to get back in. They watch from the sidelines as prices climb back up, eventually buying back in near the top, just in time for the next correction. This cycle of emotional buying and selling guarantees failure. Successful investors understand that market corrections are normal and temporary. They either hold steady or buy more when prices drop, knowing that every major dip in history has been followed by new highs. Ignoring tax implications. Here's something that catches newer investors completely off guard: taxes. In your first few years, your gains might be small enough that taxes don't seem like a big deal. But by years 3 to 7, those tax bills become significant. Investors who don't understand tax-efficient strategies end up giving away huge portions of their returns to the government. They trade too frequently, triggering short-term capital gains taxes. They don't take advantage of tax-advantaged accounts like IRAs or 401ks. They don't understand how to harvest losses or manage their tax brackets. Meanwhile, smart investors are structuring their portfolios to minimize taxes legally, keeping more of their returns working for them. No clear strategy or goals. Many people start investing with vague goals like build wealth or make money. This works okay in the beginning when everything is new and exciting. But between years 3 and 7, without clear specific goals, motivation dies. You don't know if you're on track or falling behind because you never define what success looks like. Are you investing for retirement in 30 years? A house down payment in 5 years? Financial independence in 15? Each goal requires a completely different strategy. Investors who fail never took time to answer these questions. They drift along without direction, making random decisions based on feelings rather than following a coherent plan. Successful investors have written goals with specific numbers and dates. They review these regularly and adjust their strategy accordingly. Failure to learn and adapt. The investment landscape changes constantly. New opportunities emerge, old strategies stop working, regulations change, and economic conditions shift. Investors who stop learning after their first few years get left behind. They keep using the same approaches that worked in 2020, not realizing the market has moved on. They don't understand new investment vehicles, changing tax laws, or evolving market dynamics. They become stubborn, refusing to adapt because this is how I've always done it. Meanwhile, successful investors treat learning as a lifelong commitment. They read books, follow market news, learn from mistakes, and constantly refine their approach. They're humble enough to admit what they don't know and curious enough to keep growing. The danger zone isn't starting. It's staying consistent when things feel familiar. If you're in years 3 to 7, this is your warning sign. Like, subscribe, and share this with someone who's still in the game.